Welcome to our first mentorship class. In today's lesson, I'll be taking you through support and resistance. This is the major key point in forex industry. Please pay close attention to this lesson. So when we are talking about support can be referred to an areas where buyer come in or came in as an oppositional force against the seller to push the price of the market higher. Do you get that? And when we are talking about resistance, resistance is an opposite of support. It may be referred to an areas where seller came in as an oppositional force against buyer to push down the price of the market. Do you get that? So now, when you are trading forex, you don't use support and resistance at the same time. You don't use support and resistance at the same time. So when you are trading market, first of all, when you open the chart, immediately identify the structures of the market. When you identify the structures of the market, if the structures of the market align with support, all you should be doing in that market is support. You are to be trading against the resistance. You are not in support of the resistance. And when the structures of the market is telling you that yes, is aligned with resistance, you are to be trading against the support. Do you get that? This is the mistake that a lot of people are doing in this industry. When the market is bullish, they are selling and they are buying at the same time. The time that the market is doing a retracement, they are buying. The time that the retracement is done, they begin to the time the retracement is done, either they begin to sell or they are buying. So let me show you something. Now, let's assume that the market is bullish, right? Let's say the market is creating higher high and then higher low, higher high, then higher low, higher high, and then higher low. Now, this is support. This is support. At this point, you see, the buyer came in here, they pushed the price of the market. Let's just say the price of the market came from here. Now, came from here. Seller pushed the price of the market down a little bit here. Buyer came in and pushed it higher than it before. Then seller came in and came in as an oppositional force, push it small, but they could not surpass the buyer. Buyer came in again and push it upward beyond the height of the height of the price before. Do you get that? So when you see a market like this, what you should be doing, you should be buying. You should go against the resistance and be inside of support. Do you get that? Now, when market is trending up, when you see a bullish market like this, what you should be doing, you should be buying. Do you get that? This is support. This is support. This is support. Now you wait for this retracement to come down. This peak, this up now is the resistance. This is the resistance. Is a mini oppositional force that came into the market, or for some reason that maybe some buyers have pulled off their profit. So it caused the market to retrace down. And when they see that the market have come to a good discount, they come in with a force again and push the price higher again. So some of them coming to this point, they remove their profit and then the market begin to drop down. The price of the market begin to drop down. When they see that, yes, it have come to a very good discount, they go into the market again, begin to buy the product. Then they push the price higher again. So when you are trading a market like this, you should only focus on buying and not selling, because you can see that the sellers have only short terms. They only have short length here. But when buyer came in, they push the price higher than it before. Do you get that? So when you see a bullish market, you should go in line with support. Wait for the retracement to come down, then you execute your buy. Do you get that? Then in another hand, we have resistance. Let me draw it first. When we are talking about resistance may be referred to an area where seller came in as an oppositional force against buyer to push the price of the market downward is called resistance. It's called resistance. When you see a bearish market, you should go with resistance. All these areas are resistant. These are your potential entry point. Do you get? These are your potential entry point. So at this point, let me show you. Let me show you. So at this, all these areas are just like a mini oppositional force from buyers, because those sellers that make profit, like for example, maybe someone sell a product here, and then the market dropped down to this point. He have make his profit, he pulled the profit. So for that reason, the price of the market begin to go up again. When they see that yes, the price have come up again, they begin to sell their product. Once they have sold their products to some extent, they remove their profit, and the price of the product begin to go up again. Do you get? So the price begin to go up. When they see that yes, the price have come to a certain level that they want to sell again, they come in and push the price down again. So now, if you see a market structure like this and you are buying, definitely you might probably enter loss, because sometimes the place that you're expecting the price of the market to come before you pull out your profit, it might not reach there. Maybe seller came in and pushed the price against you. Do you get? So when you see a structure like this structure signify industry are ruling this, so you need to go along with the industry. All this mini retracement that you are seeing is just like retail trader come in to catch some small move. So if you follow this retail trader, you will lose money. When you open market, follow the structures of the market based on the time frame that you are using. I hope you get that right. So let me take you to the chart and show you. Can you see now? So when you see a market like this, why should you be selling? Some people say, okay, let me show you. Can you see? We just have a little selling price around this place. This one is called a correctional price, trying to correct the price, and buyer came in and pushed the price all the way here. Do you get? So seller came in, which is an oppositional force, trying to push the price down, but in as much as they pushed the price down, it could not reach this support. So buyer came in again with a strong force and pushed the price from here. Push the price from here all the way up here. Can you see? To tell you that buyer have much powers in a structure like this than seller. Look at the height of the market. Buyer came in and pushed the price of the market above the previous height. Can you see? So when you see a market structure like this, you should be going with buy and not selling. Now, can you see again? Sellers came in with some oppositional force, begin to push the price down. As they push the price down to their own limit, buyer came in again and begin to shoot it up. Can you see? So that is how it is. When you see a bullish structure, go with support, wait for support and enter your market. And when you see a bearish market, okay, let me show you a bearish market. So this is a bearish market. Can you see? This is a bearish market. Sellers dominate this market. Anywhere you see that the trend of the market is down, your entry point should be at the resistance area and not a support area. Do you get that? Your entry point should be at the resistance area and not a support area. So that is that. This is a bearish trend. Can you see? You see that seller dominate this market. See, buyer came in small with some 2 candle and seller push it down all the way. See, buyer came in small just to correct the price, and then seller push it down. So when you open the market, determine your time frame. Whichever time frame that you are using. Read the market structure. Once you get the market structure right, go with the direction of that structure.